Hello, my name is Benjamin Z. Meller, and in this video I'm going to be talking about the differences between investing in a multifamily property through a syndication or a real estate investment trust. What exactly are the differences there? Well, good question. First, please don't forget to like and subscribe for more content just like this video. So, the structure and ownership. During syndication, a real estate syndication is actually a group of investors pooling their resources to collectively purchase a property. Typically, one investor acts as the sponsor or general partner, while the other investors are limited partners. The sponsor is responsible for managing the property and making decisions on behalf of the group. With a REIT, a real estate investment trust, is actually a company that owns and operates income-generating real estate properties. It is structured typically as a publicly traded company and is required to distribute a significant portion of its earnings as dividends to the shareholders. Investors can buy shares of a REIT through a stock exchange. What about the tax benefits? Well, in syndications offer several tax benefits, including the ability to offset passive income with passive losses due to depreciation of the asset. This can actually lead to some very significant tax savings for investors. Whereas REITs, they typically pay out 90% of the generated income in dividends to shareholders, which means they do not pay corporate taxes. So I said REITs do not pay corporate taxes. Well, who pays the taxes then? Well, the taxes become the responsibility of the shareholders and can come in the form of ordinary income as dividends are taxed, capital gains, similar to stocks, return of capital, or a combination of the three. Let's talk about diversification. Syndicates typically fund one acquisition, a single acquisition, like maybe they're going to buy a multifamily property. REITs, on the other hand, they typically invest in multiple assets. So the diversification can be a bit easier with REITs. Liquidity, syndicates are less liquid. I mean, with real estate syndication, you may see you need to put in $100,000, $200,000 for the minimum requirement. You have to also, for example, have a net worth of, if you're an accredited investor in the United States, you need a net worth of over $1 million, not including your main residence. Real estate syndicates, they have high minimum investments. Again, $50,000, $100,000 could be a minimum. Whereas with a REIT, you can buy just a single share, however, and they are more liquid. But with syndication, as a limited partner in a real estate syndicate, you have limited control over the property and its management. The sponsor makes the decisions on behalf of the group, but you can still benefit from the expertise of the sponsor and their team. With a REIT, when you invest in a REIT, it's similar to investing in any other publicly traded company. You have little control over the day-to-day operations and decisions of the company. However, you can benefit from the expertise of the REIT's management team. In conclusion, both real estate syndications and REITs, they offer unique benefits and drawbacks. If you would like to learn more about investing, you should just send me an email, ben@benjaminzmeller.com. Just email me, ben@benjaminzmeller.com. I hope that helps, and I wish you good luck with your investing.